Good day, everybody. Welcome to the Deal Scout. On today's show, we're going to talk about being your own financier, your own bank, and we're going to learn some things about that. So, on today's show, we got Mark. Mark, welcome to the Deal Scout.
Thanks, Josh. Glad to be on.
Yeah. So, all right. So, give us an idea of what we're going to talk about today, like on this interview. What could people expect?
Well, think about the places in which you lose the most wealth and the industries in which make the most wealth in our world. If you're like most people, banks, finance companies, mortgage companies, and more can typically be the biggest leeches on your wealth generation. I believe in leverage. I believe in using smart leverage for investments and more. But what if you could become your own source of financing, your own banker, and become the most profitable business in the history of all mankind?
Hmm.
That's sort of what we'll be covering, I think, in our time together today.
Sounds good. I like this. Leeches on your wealth. Like, if you think of it that way, right? Like, you're like, okay, yes, I believe in leverage. Sometimes you got to borrow to get and you got to,
Mm.
leverage things. But if you think about it differently and you go, what's good leverage, but what's leeching, what's taking away? Before we dive into that, Mark, tell us a little bit about what are you up to? Who are you and what do you do?
So my name's Mark Willis. I'm a certified financial planner. I own the firm Lake Growth Financial Services. We're a financial firm in Chicago, Illinois. We work with clients all over the country in all 50 states, and we specifically work targeted in a one-on-one advisory role with clients to sit down, really understand not just their data points, their net worth, whatever, but also their purpose, their values, their goals and objectives, what they're trying to accomplish on a big, grand scale. I oftentimes think that financial planning sounds so dry, but Josh, if you've ever had one of those like really good conversations, with like brothers or friends, I had one where I was in a field. It was high school. I was in a field laying out, looking out on God's creation, looking at the universe, all the stars in the sky. And we were just sort of pontificating on life and the future and where life might take all of us. And it was just a really remarkable discussion. I really think that money conversations could be like that if we treat them as such, right? Money is this very interesting tool. It's not the purpose, it's not the end, but it helps engage all the important things in life. Your family, your marriage, your spirituality, your giving, your legacy, your own capacity, right? Your own potential. And so if you treat money in such a way, you can really have an amazing conversation. And that's what I'm privileged to get to do with clients all over the country. My background is, definitely not one from a silver spoon. I did not grow up with a lot of money. And in fact, we graduated from college, my wife and I, mostly on my balance sheet. When we got married, the student loans were in the six figures. And I would happily talk through some of that with you. But really, the point is we found a way to break free from that. And more than that, to really take control of our financial future.
Yeah. Yeah, let's talk about that, right? So I'm 40 now as a time of recording, just recently turned, over the
Hey,
hill, like
happy
they would say.
birthday.
Thanks, man. And one of the things when I was growing up, when I was getting out of high school and such, I was exploring what do I do with my life? And I think a lot of, young men have a hard time figuring that out. But one of the things that the generation before me, my father was like, you have to go to college. Now, I grew up on a construction site, so college meant who's going to pay for this thing? I wasn't smart enough to get a full ride, so I had to borrow money to do so. So racked up student debt to get a degree in business administration and management, not knowing what I truly wanted to do. And then I get out with this student debt, and then the idea was with a bachelor's degree or with a business degree, you'll make more money. And that might have been true in the early 2000s, but what I'm finding now is almost like most of the time I talk with people or recruiting arms or anything like that. Not that I'm looking for a job. I'm a business owner, right? I'm a terrible employee. Is they don't give a crap. Show me your track record and what you could do. So that
Mhm.
debt that we have accumulated, I don't know if it's truly paid off. What's your experience?
Well, yeah, you think about most other important areas of life. I think about computers. I think about the computer industry. How much have we advanced in your laptop you're using right now, or your
Yeah.
smartphone in your hand? And how much has the price, relatively speaking, come down for those, or your flat screen TV, right? I saw, out on the front lawn it was trash day in the neighborhood down the street from us. I saw this massive, giant, stand-up flat screen TV from looks like 30 years ago. I bet you they paid $1,000 for that back in the day. It's probably worth, well, they have to pay to throw it out now. That's how old that thing is now, right? And your computers, your laptops, the value has gone up, the price has come down in certain areas of technology and more. I think the technology of education, it's the opposite. The price has gone up, the value has come down. To your point, how much do they really need to know that we have a certain stamp of approval from some professor across the country, right?
Yeah.
What have you done for me lately is more likely the best question you can answer a job, when you're a job applicant for a new career. So yeah, I'd say, really student loans, they are lower interest, although they've come up. I think the last checked, they were in the mid 6% range, which is, 2 to 3 times more than a treasury is charging these days. So, would I tell my daughter to go to college as it stands today? Probably not. We want to really give for her the skills, certainly, to survive and thrive. I think the biggest skills I learned in college was critical thinking. But here's the catch. I applied it to my area of focus and study, critical thinking skills in my area of focus that I went to school for. I ended up getting a master's. I say they held me back for graduate school. But then I didn't apply it to other areas of my life, specifically money. And I'll tell you exactly what I mean. I had racked up all this debt and I thought I was so smart with all my, fancy degrees, whatever. But when it came to money, I followed blindly a radio host. And you might know the one I'm talking about. His last name rhymes with Samsey. Yeah. All right. And I didn't question a thing he said. I believed every word that came out of his mouth like it was, Moses bringing it down from the mountain. Okay. Like he had written the 5th gospel. And I just had a moment with a mentor of mine. He was sitting down with me and he was talking to me about some of the strategies that I've now become really just enthralled with, compelled to share with folks. And he said to me, Mark, is it possible that Dave Ramsey could be wrong about something?
Oh, blasphemy. Right.
And my little mind went kaboom, because all I had ever imagined was that, again, he could not speak a lie, that he had a corner on truth. I was not thinking critically. Those same skills that my mentor and former professor had instilled in me, thankfully he did, I had not yet applied that to more of my life. I had sectioned off my critical thinking skills to only a certain area. So money is this vague, sometimes scary concept to young adults. Mm-hmm. But I think also there's this kind of a arrival syndrome that we start to get once we get into our 40s, 50s and more. We start to say, yeah, I've got it all down. I've figured it all out. I know the pathway. This is the best. We become sort of, I guess, comfortable with flying at 100 miles an hour, not realizing that our airplane is fighting into a headwind that might be 200 miles an hour coming right at us, right? Mm. So we think our little airplane is moving forward and we're feeling good about it. We see our little dials on our airplane. We see how fast our mutual funds are flying, right? We see how fast how low our interest rate is on our mortgage. We see all the right dials and we think this is as good as it gets. We think we've arrived in our financial life, but we don't think critically in our 40s, 50s, and 60s because we think we've made it, but we don't realize that all of our money is flying around in this environment. No airplane can fly in a vacuum. It must fly in an environment. And what is the environment? It's the financial universe that we all exist in. We're all swimming in this environment. And we might not realize that the headwinds of banks, interest, leverage against us is actually pushing us backwards, not forwards. If your airplane can fly 100 miles an hour in one direction, that's great. But if you've got a headwind coming at you, you better just land that plane and wait for the wind to die down. Because no amount of pushing, no amount of taking additional risk on your mutual funds, no additional wiggling on your refis are going to help you push against 200 mile an hour winds. Now, what can we do? We all think we wait till the wind dies down, right? That we got 100 miles an hour on our airplane. We can now fly. The wind is gone. We're going as fast as we can go. We think that's as good as it gets. And that's the arrival syndrome. And I'd say that's the worst virus, worse than anything physically you can get, is the arrival syndrome. The arrival syndrome is where you say, I'm as good as I'm ever going to get. You might as well be dead if you think that to yourself, right? The best way to go, the best way to go is to wait for that tailwind behind you. When the wind is pushing that little airplane at 200 miles an hour, plus your 100 that you can do with your engine there, now you've got some serious distance you can fly, right? So that's the power of thinking critically about money, something I never thought I could do when I was just getting out of college.
Yeah. So you mentioned, graduating school. You didn't grow up with a silver spoon in your mouth. You exited college with a, six-figure school loan. Like, how in the world did you eradicate that? Are you still paying it off? Fannie Mae, or what is it? Sallie
No,
Mae?
we divorced her a long time ago. Yeah, I
Ah,
kind of jokingly say I married two women in college, my beautiful wife and Sallie Mae, but we got
yeah,
her out of our marriage a while back. Yeah.
yeah.
And it was a pretty massive, wonderful, eye-opening experience, actually, Josh. I can share briefly about it. I know we're here to talk about future and investments and projects for becoming your own source of financing, but one of the biggest stumbling blocks to building wealth is the choice. A lot of the questions that I have with clients over Zoom or over the phone when we're having financial discussions is, Mark, I've got this debt. Should I pay off the debt or should I invest? And there's a choice, and they believe it's a either or. I actually would like to break that distinction and say it can be both and.
Okay.
Um, so the original plan my wife and I had was to pay down the debt using Dave Ramsey's debt snowball method. You might be familiar with this.
Yeah.
You pay minimums on all your debts, and then you throw as much as you can on the smallest balance or the one with the highest interest, whatever you prefer. And that was our pathway. We had paid down a good chunk of that student loan debt the old fashioned way using the debt snowball method. That's when my mentor came into my living room, sat down about halfway through our little project of doing that, and said, Mark, is it possible that there might be a better way, that Dave Ramsey could be wrong about something? And so he shared with me a concept called bank on yourself. And that's what we ended up switching to pay off the remainder of our student loan debt. That strategy of bank on yourself, becoming my own banker, buying back my debt, not just paying it off, not just waiting for the wind to die down and to get finally onto the project of saving and investing. No, we would have been 4 years older. We would have lost the 4 years of saving and contributions. Think about that, Josh. If you could go back to when you were 25, 26, 27 and start packing massive amounts of money in to something that would grow compound for the rest of your life, those dollars in your 20s are way more valuable than when you're 40 or 60 or 80. Heck, start anytime you want, right? But for us, we woke up to the fact that there was an opportunity cost to paying those student loans. Not just the interest that was charging us, but the powerful loss of growth we could have earned on a dollar had we saved it rather than thrown it down a hole and paid off Sallie Mae and her cronies. So
Yeah.
that's sort of that was sort of the downside to paying student loans off with the debt snowball method. We lost that dollar for the rest of our life, and our children and our children's children's lifetimes will never see those dollars ever again. They're in the hands of a bank called Sallie Mae down the street. I would like to suggest there's something better than just paying cash, whether it's paying off your debts or buying your car or investing in your next real estate deal or whatever it might be. There's something better than just directly paying cash. And that's using the strategy bank on yourself, which has been absolutely transforming to us since the last, I guess, 10, 11 years now.
Okay. So reveal banking on yourself. Like, teach us what that is and how you do this for your clients.
Sure. Okay. So first of all, I need to just say again, I'm a certified financial planner, and I never thought I'd be talking about this specific tool. It's a specific product and tool that we use to help people accomplish their goals. Of all things, it uses dividend paying whole life insurance. Now, that right there shook me when I first heard it. Again, is Dave Ramsey a big fan of whole life insurance? Of course not. He's a hater to the nth degree. And so it took me about 7 months to really get my brain around this concept. At its focus, it's using a dividend paying whole life insurance chassis, but it's really modernized for banking. And let me kind of explain what is whole life insurance. Then we'll talk about how it can be used for the banking purposes and functions in your life. So it is whole life insurance. So whole life insurance has been around for 200 plus years, Josh. It's a contract. It's an insurance contract, which means much like real estate contracts, It's a true wealth asset. Unlike paper wealth of stock market, it's true wealth. It's real wealth. Real estate uses contracts. Someone once said, Mark, I've got 10 properties. That's my real wealth right there. I've got 10 properties. They're fully paid off, no mortgages. I get a nice check every month from the renters. And I said, well, that's awesome. Congratulations. But what is it that really holds those properties in your in your balance sheet? Is it the brick and the mortar and the tile and the grout? No. If you didn't have a contract with that real estate property, if you didn't have the deed, or you didn't have a contract with your tenant, all you'd have is a bunch of squatters' rights, right? Whoever has the biggest shotgun would own that property. Mm-hmm. So contracts are really the true basis of all wealth, real wealth, not just paper wealth, but real wealth. Okay, so whole life insurance uses contracts. And the contract itself says some pretty interesting things. Number one, it grows on a guaranteed basis. So the death benefit can grow if there's paid up additions, and the cash value can grow guaranteed every single year, no matter what the market is doing. So that's the key first piece to this puzzle. It's a guaranteed increase in your net worth every single year, no matter what the stock market's doing. So that's the first piece. There's a second piece to this, and that is that you have access to that cash. All right. So not just the death benefit. Can't get that until I move to the other side of the grass, Josh. But the cash value, the money you can use on this side of the grass, is called cash value. It's the money that you can access for any reason. There's no prohibited transactions. Okay. Unlike a self-directed IRA where there's a lot of red tape, there's no prohibited transactions. I can invest in real estate. I can pay off my student loans. I can send my daughter to college or Disney World. It doesn't matter. It's your cash. So that's the second piece. And if it's designed correctly, it can be done with no taxes due on that money. So you could have $10 million of cash value and be taking money out of that thing every single year, every single month with no taxes due. Does not count against you on your tax returns or count against you for Social Security. Doesn't count against you for the FAFSA form. If you're sending your kid to college, you can take off the balance sheet that asset, and it doesn't count against you when you apply for college. So there's some really cool things that camouflage that money for several different purposes. So that accessible cash is number two. So number one was it grows guaranteed. Number two is the cash is available, accessible to you, liquid, with no taxes due if we design it correctly. Third is, and there's only four, so I promise I'm going to hush here in a minute. The third is it's life insurance. It is actually life insurance. So thankfully, we're able to solve that need for most families, because most families and business owners need some kind of coverage for their business or for their family should they pass away too soon. And the life insurance automatically leaves my family more money than I'll ever be able to save for them. Let me say that again, because that's pretty cool. If I put $1 into a savings account and I died tonight, how much does my family get?
Depends if there's taxes, right? State taxes or whatever. But
yeah. Oh, that's a good point. Yeah, basically $1 minus Uncle Sam's portion. You're exactly right. Yeah. If I put $1 into my policies today, it could be $7, $9, $12 if I passed away tonight, depending on my age and my health and all that. So that's just sort of remarkable, and just just to kind of understate it a little bit. And that is also income tax free when I leave it to my family. And then finally, the purpose of this for banking, why do we call it bank on yourself? And that's a trademarked coined phrase by Pamela Yellen, by the way. She wrote the book, Bank on Yourself. This idea of using whole life insurance like a bank allows you to borrow against the cash value, not withdraw it, but you can actually use it as collateral, borrow against it, and use it for any purpose you need: car, college, real estate investing, buying a business. And the money in the policy, and this is so huge, Josh, if you access the money via a loan, the policy itself will continue to grow as if you had not touched the money. So we're simply using the cash value like a collateralized asset. It is collateral for your loan. You're borrowing from the life insurance company. And if it's designed the bank on yourself way, and there's lots of people out there who design it incorrectly, and I got to say that up front, but if it was designed the bank on yourself way, let's say you got $250,000 of cash value, and let's say you borrowed out 200 grand to invest in a syndication deal. That year, your policy will still give you guaranteed interest and dividends on the entire $250,000, as if you hadn't touched the money.
Hmm.
To
And
me,
then
that solves the problem of having to choose between paying off my debt and saving for the future. It's uninterrupted compounding. Your money does two things at once.
so this is kind of in the weeds tactical, right? How do you set up a structure? You set up this loan, right, where you pull the money out of the cash value, and then you go back making the payments every month at what type of interest rate? Like how does the mechanics of that deal work?
It's actually very simple, and without making it simplistic, I will say it's a lot like your smartphone. I don't know how I got a phone with a camera, a GPS, a keyboard, an amazing machine that has all these different functionalities. But all I know is I need to just swipe here and the thing works, right?
Mhm.
So in practice, it's actually very simple. And then I can get into more tactical specifics. But in practice, what we would do is have a one-on-one discussion with clients to see if this is in their best interest. We don't want to set this thing up just because it's cool, sounded cool on a podcast, right? You want to build it into your overall financial life. If it is a good fit, then we would go through a life insurance application process, which is free. You go through underwriting, and then you see if you can be approved. If you're approved, you just start funding the policy at whatever rate and pace you wish. It might be monthly, it might be annually, it might just be one lump sum, and then you're done. But once you put the money into the policy, they call that premium. Josh, the next step would be to just simply request a loan. And it can be as simple as going online to the life insurance company's websites, click here, click there, and request a loan. Basically, the application for the loan is like two questions long. How much money do you want, Josh? And what bank account do you want us to send it to? It's like
Wow.
as simple as it gets. And then they give you the option to repay that loan. Hey, Josh, if you want to, here's a way to repay this loan. You can pay it monthly, you can send in occasional repayments, but nobody's going to require that you repay that loan. The insurance company does not care if you repay that loan or not. Now, how is that possible, right? This is a loan after all, right? Aren't we back in the bank's pocketbook here? No, if you borrow from a life insurance company, they already have your collateral. So they don't need you to repay it. If I died, let's say I had a $10 million death benefit and I borrowed, let's say 500 grand from a cash value, okay? And I died that night, my family would get $10 million minus the loan of what I say, $500,000. So
Yep.
they'd get $9.5 million income tax free. And hopefully they'd have 500 grand sitting in my bank account or in the real estate I had just bought or whatever else, right?
Hmm.
So in one way or the other, the insurance company knows they're going to be repaid. So there is no required repayment plan.
Got it. So let's just say I have $1 million, cash value whole life insurance plan. I pull out 100 grand to do some investments or to pay off Sally Mae, whatever the case may be, right? And I don't have to set up a payment structure of saying, okay, I'll pay $200 a month for the next, 150 years or whatever the case may be. So
Yeah.
that's not a requirement while filling out these.
No.
Wow. Okay.
Oh, there's no repayment structure at all. I'll tell you a story of a couple that they do these really high end real estate fixer uppers. So
Mhm.
they'll buy this old antique home and then put a lot of money into it, and then they'll flip it and sell it, for 5 times the price, whatever. They're really good at what they do, and they make several million a year doing it. And so they'll borrow from their policy, and then they'll take 2-3 years sometimes to rehab that house, right? I mean, it's like the trophy home type fix and flip.
Yeah.
And then when they do sell, that's when they repay the loan in full. That's all it is. There's no monthly anything for them. They just wait till the house sells. Now, before they would have to like beg a bank, go through underwriting, show all their financials. Um, it's a very uncomfortable process for them because of their situation. They just don't like going to the bank, and they don't like paying the bank a monthly check every month in between purchases and sales and fixes and flips. So this gave them a way to avoid having to do all of that with a lot more guarantees.
Can the bank call on the loan or the insurance company? So a year from now, let's just say the market tanks, right? Not a prediction, just saying what if, right? And the bank goes, oh, by the way, you borrowed against your policy at a $500,000 bucks. We're calling the note. Could that happen, or does that happen?
Um, It sure can with banks.
Yep.
It sure can with HELOCs. It
Yep.
sure can with lines of credit. It does not happen with life insurance loans. There's no calling of a loan of a life insurance loan. And it's written right into the contract, so they can't change their mind later. Your right to your cash value via a loan or withdrawal is hard coded right into the contract between you and the insurance company. And they cannot go back on their contract. I mean, that's a unilateral contract baked right into Western civilization's belief in contract law. They can't go back on that sort of thing. Otherwise, boy, they're going to be in a world of hurt and probably out of business as an insurance company. So no, everyone else, you know, that old Mark Twain quote, a banker is a fellow who will lend you his umbrella when the sun shines, but wants it back as soon as it starts to rain. So there's a lot of ways you can borrow. What about a margin loan on your brokerage account? What about a HELOC on your house or other properties? What about a business line of credit? All those options can be called. And unfortunately, banks love to call you when you don't want to hear from them. And they never return your call when you're trying to get in touch with them. So that's kind of the unfortunate truth of most ways you can borrow. But thankfully, life insurance loans are not callable.
Yeah. All right. So let's just say I wanted to start today, and let's just say I'm, an ideal client. What would that look like? Let's talk dollars and cents, right? So I'm coming in and I go, I want to set this up. Like, give me some idea of, I've never done this before, and I want to take baby steps, but the opposite direction. Like I want to go this direction. I've got my term over here. I followed the blueprint over there, but I want to add to it this. What would that look like?
Yeah, and you can. That's a great point, Josh. You can have some term insurance and you can get whole life insurance. It's not like you have to choose between one or the other. In fact, if you do it right, you can even buy term insurance that you convert later if you bought it from the right company. So we can talk about that if you want.
Okay.
But yes, you can start these policies at relatively modest amounts. I mean, really, a couple $100 a month is probably as small as I'd want to suggest for an adult. Younger kids, even smaller than that, $100 a month, whatever. But the more you put into them, it's sort of like a savings account, Josh. The more you pack into these policies, the more you'll have. Mm-hmm. My biggest regret is starting two policies. My first two policies with my wife and I, we started them early on when income was low. And we were told by another financial professional to go as big as we could to challenge ourselves. But we wanted to dip our toe in first, right? Now that those first two policies are capped, locked in, they're maxed out at like $500 a month each. I can't put more into those, even if I want to. So, anyway, to answer your question, yeah, you can drip in some money as a monthly amount like that, $500 a month per policy for us. If you do like 18 grand a year, I'll just give you some quick numbers. Guy who's 36 years old who starts a policy at $1,500 a month. Okay, $1,500 a month. In the first year, the cash value, this is a recent example here, was about $11,100 in the first year. And a death benefit of 650 grand in the first year. Now, right there, let's talk about what just happened. Well, one, he put in $1,500 a month. That's 18 grand a year, right? Yeah. And he had a death benefit of 650,000 and a cash value of $11,000. Wait a minute. Where did his money go? He paid 18 grand to this insurance company. Why does he only have $11,000, $11,100 available? Well, there was a cost of insurance. So you bought some insurance with this policy. In the first year, you're going to see most of your expenses come out. Now, Dave Ramsey's response would be, look at all that commission. And no, I don't get paid that much. Usually the insurance company gets about half that, and my firm will get the other half. But the key would be you get to keep $11,100. Old-fashioned whole life insurance, Josh, would have zero cash value in the first year. Zero. So we flooded this thing with as much cash as we possibly could, but it still cost you some money. So don't do bank on yourself type policy or any kind of whole life insurance if you need every last penny right now, this moment, today. If you need all your money right now, this moment, right away, and you have no desire to grow your money in the future, I'm sure there's a lovely checking account that you could open at the bank down the street, and they cost you nothing to get those. But we also know you lose some stuff when you open a checking account and keep your money in there too. Now, lastly, and just quickly, over time, this cost goes away. So case in point, in the third year to the fourth year, his cash value grew from 40,000 to 58,600. Now he's still putting in 18 grand a year, Josh. Okay. So I know I'm giving you a lot of numbers and this is a podcast and not always great to do numbers, but roll with me for just one more minute. If he's putting in 18 grand a year and by year 3 to year 4, the cash value grew from 40 grand to 58 grand 600, that's an increase of 18,600 bucks. That's more than he paid them that year. More than he paid them. He paid them 18 grand and it grew by 18,600 bucks. And his death benefit at that point is over $800,000. So Josh, he gave them 18 grand. His wealth increased by 18,600 bucks. And he's got a death benefit of over 800,000. At that point, who is paying who for that life insurance?
Mm.
Well,
If you're taking that money out, then you're paying yourself.
yeah. Well, and the insurance company increased his money more than he contributed to it that year. They paid him a net $600, you might say, just to continue this policy. Now that's in essence, right? It's not, they're not writing him a check for 600 bucks. He puts in 18,000 bucks. It grows by 18,600. This is just an example, of course, but it just shows how these things become more and more efficient over time. Go out 20, 30 years. Let's go out 20 years and then I'll be done. The same guy's putting in 18 grand and it's growing by $40,000 that year alone. Almost, he's got $540,000 of liquid cash in the 20th year. Now that is a more and more efficient machine every year. And the point would be to use that cash, not to leave it locked up in the policy, of course, but it's becoming more and more efficient the longer you keep it.
So let's just say I do this, 1,500 bucks a month. Year one, I've got, $11,000 cash benefit ish, right? At year one, could I pull some of that money out and start using it?
Yeah. Yeah.
Can I increase instead of going 1,500? I go, I really like this thing. Let's put 2 grand. Let's put 5 grand.
This policy will be capped. It's almost like you get a bucket from the insurance company every year. Here's your bucket. Can you fill it up to the full? Yes. Can you overfill it? No.
Okay.
Could you halfway fill it? Let's say you're in a tough spot that year. You can fill it up halfway, let's say. Most of the premium is optional to you on these. Okay. So buckets can be halfway full or 100% full, but they cannot overfill. If you said, hey, Mark, I love this thing, like me, my first 2 policies, 500 bucks a month, that was my bucket. Okay. And I said, I really want to put 20 grand in this thing. I want to put 60 grand a year in this thing. I want to put 250 grand a year into this thing. You can do that, but you need more buckets. When God makes it rain, Josh, you got to get some more buckets. Put those buckets out there where you can catch the rain.
Now, I'm a little skeptical of the future of insurance and the insurance companies. Like, now they're the biggest industry, companies in the world and such like that. But, what could go wrong in terms of like the insurance company? Let's just say one of them goes bankrupt, right? What happens to my policy? What happens to me, my family?
Yeah. Well, you get to keep on living. I guess that's one thing. They're not going to come after you for your life and or repo your life or anything like that, Josh. So that's good.
Yeah.
But you bring up a great point. In fact, let's go back to 2008. Great example of a world global financial meltdown. That wasn't just your run of the mill recession. That was a financial crisis. Okay. The world was at the brink of losing faith in its own economic system. That was not just small potatoes. What happened there? In 2008, what happened to the stock market? Many people's 401ks became 201ks, meaning their net worth got cut in half, right?
Yeah.
Many people saw banks go bankrupt. In fact, 454 banks went bankrupt in 2008. That's not a small amount, right? That's not just one little branch of your local town's credit union. That's the entire bank goes bankrupt in 2008. In that same year, no life insurance companies went bankrupt. There was one small insurance company that went bankrupt the year before. Okay. And it was Lincoln Memorial. So I don't know who they are now. I mean, they're gone now, but what happened to the people that had a Lincoln Memorial? I wouldn't have recommended them. They were not a mutually owned company. I look at companies that have been through this sort of thing before. I usually only recommend companies that have been around for over 100 years. And not only have they paid their guarantees and their claims, Josh, but they've paid dividends, profits on top for over a century without fail. That's the kind of company I'm looking for, right?
Yep.
But what about that little company? What happened to those guys and gals that had policies with Lincoln Memorial? The state insurance commissioner of Texas steps in, and that's their role, is in the event of some sort of dissolution like that, the state insurance commissioner steps in and gave those policies, basically transferred those policies in the interest of the policy holders at Lincoln Memorial over to another company. I think it was Banner Life. And Banner Life still holds those contracts today and was obligated to take them on. So they don't, the insurance company might go away. Basically, you just see a new logo at the top of your annual guaranteed interest and dividend sheet if you were the policyholder there. Now, is that foolproof? No. Could the entire world shut down? Yeah. But remember, your money has to live somewhere. Got to live somewhere. And if the world is going through something worse than 2008, because it would take something over, I mean, many times worse than 2008, it would take something even worse than 2008 for insurance companies to be falling like flies, right?
Mm-hmm.
I jokingly say, after the nuclear war, the only thing that's going to be left is going to be Twinkies and life insurance companies because they're that resilient, right? But point is, your money has to live somewhere. Where else would it be in that worldwide catastrophe doing better than, say, a life insurance company that has guarantees, contracts, and your liquid cash available? Is it foolproof? No. Could you lose money with this? Of course. Yeah, you've got the cost of insurance, Josh. But I would say for folks considering this, it really needs to be thought of as a long-term financial vehicle. You want to pick the right company.
What would you say is if I were to do this, or a fellow deal maker is going to do this, like what would you say is like the minimum for this to even make sense?
Well, make sense is a great question and a great phrase. I don't know, because every person will come to me with a different answer to that question. For some people, their minimum might be 400 grand because that's what solves their problem. Josh, you know this, right? Whatever solves your problem is really the key. Is really the there we go. Sorry, I might had a phone call come in. Yeah, really, it's whatever brings in the and solves the problem. That is the minimum needed. Now, on a functional basis, yeah, a couple $100 a month would be your minimum, but that doesn't always solve a problem. At the end of the year, let's say you're putting in $500 a month, you might have $4,000 of cash value at the end of the year. Now, could you do something with $4,000? Yeah, you could borrow against it, go on a little vacation, maybe pay your annual property tax if you're, in a great state like Texas or something. Probably not. Illinois, probably not. So it just comes down to what you're trying to do. Josh, we had a guy who was doing a real estate deal, and his minimum needed was about 800 grand that he wanted to dump into the policy. So really, I hope that answers your question there.
Got it. So I start out with my first bucket, and let's just say it's a smaller bucket, but then the next bucket, I say I want a bigger bucket this time, and I just keep creating buckets, right, as a vehicle to borrow against. And could I borrow against one and fund another?
You could, yeah. It's not necessarily advised, because now you've got one loan, and then now you've got an ongoing premium with the new policy. I know a lot of people on YouTube who would love to tell you to do that because they get 2 commissions.
Right.
They get 2 commissions off that. But no, I generally say, fund it with assets or cash flow or sale of windfalls and inheritances, but don't fund it with other policy loans. I have done that myself in the past. In fact, I had a tough spot one time. I was going through a tough patch with my business and just getting started in life, and all that. So we borrowed from our policy to pay for the policy. It also covered for a medical event that my wife needed. It covered some other of our monthly cash flow for our business and our family, and it paid for the premiums of the policy. And what's so cool, Josh, is the policy continues to grow like we never touched that money. And so, tell me where I can find a 401k that could do something like that, right? And then when we were back on our feet, we just paid off the loan, and the policy had continued to grow like we had paid for it out of pocket the entire time.
Could I borrow multiple times? Like, let's just say I borrow $4,000 the first year and I don't pay back yet. And then the next year, the cash value increases. So I borrow another $2,000 or whatever. Could I do something like that?
Yeah. Yeah. It's all considered one loan to the insurance company. It's a lot like a HELOC, if you will. Okay. In fact, that's the best corollary to what I see this doing in the real estate world is the HELOC. A HELOC uses your house as collateral, but the house keeps growing in the neighborhood, whether you borrow against it or not, right? Now, there's nothing guaranteed about home values.
Hmm.
We learned that in 2008. But much like a HELOC, you can borrow against your life insurance policy, and the policy will keep growing like you never touched the money.
Mm.
And you can borrow 10 grand this year from your HELOC, 20 grand next year from your HELOC. And it's all just considered one line of credit. It's sort of like that with your life insurance as well.
Got it. All right. So this is pretty cool. So tell me about, you know, what did you study in school? You said you got held back for your master's. What did you study in school?
Yeah, I went to school for seminary and went to get my master's of divinity.
Oh, okay. So how does a guy who goes to take over a pulpit get
Yeah.
into the world of financial advisory?
Well, my favorite book of the Bible was the book of Numbers, obviously, Josh. Just
Yeah.
kidding.
Was that a
No,
dad joke right there?
yeah. I keep them all in a database. Yeah.
Oh
So,
gosh.
yeah. Ooh. So the answer is really just I love the awkward conversation of God and money, I guess politics and health, I guess,
Yeah.
all the things that are really tricky to talk about. Why? Because they impact so much of our lives.
Hmm.
Honestly, I got through seminary never wanting to be behind a pulpit. That wasn't my jam. We had moved to Chicago to help with a ministry, helping start house churches and small groups. So I never really wanted to be the preacher guy. Nothing wrong with that. I think it's great. Ministers, pastors are doing a great work, but it just wasn't my jam.
Yeah.
So I thought, well, what can I do? And I noticed that I was having one, I'd had no real education about money myself, and I needed to get learned up on it for my own personal needs. Two, Jesus seems to talk about money quite a bit. And there's a lot connected to the human heart when it comes to how we deal with this relationship with this thing called money. In fact, sometimes it's capitalized in the Bible because it's a, it's got a it's a personification of something. Okay. And it can either help you or take you down a very bad road you don't want to go down.
Mm.
And I noticed personally when I would talk to people about money, there were more tissues involved than when I would talk about faith or, you know, doing the whole church and Christian thing, right?
Hmm.
So to me, for me, it's a pathway, it's a discussion point, it's a way to hang my faith in a way that helps people, guides people, and that to me, I suppose, is one reason why we ended up doing this. You find ways to solve people's problems, and that's kind of what we're aiming for.
Now, in the biblical community, in the Christian community and such, there's a phrase that is used incorrectly, and I think I'll share it with you, and then we could unpack it. Money is the root of all evil, right? The Bible does not say that specifically. It says the love of money is the root of all evil, not money. But like in growing up in a church and such like that, like we did not talk about money unless the offering plate was being passed, right? Then it's you
Right.
know we talk about money time. I didn't talk about money with my family, growing up, except if they didn't have it, and we were freaked out, and they said you can no longer get school lunches or buy ice cream, or you have to wear Kmart shoes instead of Reeboks back in the day, right? Or the pumps. So uh, when people are talking to you, like how do you approach that awkward thing, and why is this so important to you?
Well, you're right. The love of money is the root of all evil. What does that actually mean? I'm not going to go into Bible study mode or anything right now. I promise your listeners and you, Josh, that I won't. But there is something rooted at the base of money, and I think the key there is: does it satisfy you? Does it bring you what you want, or is it just a tool that you can use to help emphasize the values and the person that you're becoming in life? Money does not make you happy. It just makes you more of who you already are.
Hmm.
If you're a great, valuable, giving person, you're going to be an incredible, world changing giver with more money. If you're a jerk and you end up with tons of money, you're going to just be a really big jerk.
Yeah.
Yeah. So I love what you're saying there, because really there's a relationship we all have with this thing called money. And there's a great book out there on the topic. It's called Debt, the First 5,000 Years
Hmm.
by David Graeber.
Okay.
Now that's a title for the ages right there, Josh, because it says money has existed through debt since as long as we've got a human historical record. Okay. So to me, that sort of reminds me of when I was going to school in Texas. When you would drive through these small towns in Texas, maybe you remember this from your days in Dallas, there'd be these small little towns, and these towns would have basically three buildings. It would have the bank, the church, and the bar. And that was sort of the order. You drive by them in that order almost. And so I kind of imagined this story as I was driving through these towns. I'd imagine a man or woman walking into a bank and then losing their shirt on the loan that they borrowed, right? So then they go to the church to pray. And finally, they go to the bar to drink away their sorrows. That was sort of the pathway. And I think many business owners, heck, Americans, Canadians, the world over, worldwide, banks are the biggest profit takers in the world of all time. And it's not even close, right? Look at how banks are the biggest building in your town. And what else do we need to say? So as a certified financial planner, I don't care as much what your rate of return was on your mutual funds or your real estate portfolio. That's fine. What matters to me more is who's sitting behind the banker's desk in your life. And if you are behind your own banker's desk, you're going to win. If somebody else is behind your banker's desk, they're going to win. It's as simple as that. I mean, there's plenty of proverbs. There's plenty of parables of banks and banking and bankers. I just like to think of bringing banking back down to the you and me level. We've got major, mega, worldwide conglomerated banks that take over the lives and work us to the bone. The average American, according to the U.S. Commerce Bureau, spends 37% of their money servicing debt of all their income. Josh, can you imagine that, man? That means a third of the average American's day is a slave to a bank. So how does that impact our human heart? How does that impact our marriages? How does that impact our relationship to our children? You wonder why people don't spend much time with their kids or with their spouses. You wonder why divorce rates are so high, suicide rates are so high. Get banks out of your life, bring it back, bring the banking function down to the you and me level, and watch the relationships in our country change for the better.
Yeah. On the balance sheet, are my kids considered a debt or an asset or liability? Because you say, who do I work for? I work for my kids, I think.
Yeah, there you go.
And diapers, man. Holy
That's right. There's some exacting bosses. I'm telling you, man. Love it.
Yeah. The squeaky wheel gets the grease, right? Or the crown
That's right.
gets whatever they want.
That's right.
So let's do this. I've got one of the things that I like to do on my shows is, I have conversations, right? And I could ask you any questions. We could talk about deals, but like the thing I like about the Deal Scout, this show specifically, is we talk about deals and we talk about, more importantly, the deal maker. We get to know, like, and trust the deal maker. So I could come up with decent questions, but like sometimes pulling out a card and asking the questions on here. So why don't you tell me when to stop? I got some cards with questions on it.
There you go. Stop.
Okay. So I'm going to ask you this question, and which makes me nervous because I have no clue what it's going to say. I'm not a mechanic. I don't know how to, count cards or whatever. But the question is this, and you get to ask it. If you had to come up with a new class that everyone is required to take in school, what would it be?
Man, well, I think the theme of our episode, we'll just keep rolling with it. What if you could reimagine the financial discussions you have with your children, with your parents? I think one of the biggest missing pieces of my education was the financial education. I didn't learn how to balance a checkbook. What is a checkbook, right?
Yeah.
So I didn't learn what credit cards were. I didn't learn what student loans were. I jokingly talk about like falling in love with this thing called student loans without knowing the ramifications of being wedded to Sally Mae. And so that's a mega one. But I would say, what if you could treat banking like a course in school? What if you could bring your children into that education process? I feel like most of our listeners are wanting a bigger future for themselves. Otherwise, you guys would be like checked out watching Netflix, not listening to an awesome podcast like this. So if you want a bigger future for yourself, oftentimes that can mean education for yourself and for those you love, including your children. What would happen if you could teach them the principles that we've been discussing today to land their financial airplane and wait for a tailwind? How much better a life would your children have if they weren't pushing against a mighty headwind coming at them, right? Um, we drive ourselves nuts because we let our financial life war against us. Okay. I had a guy one time, he was making a great income, white collar doctor, doing great for himself. And he was so proud of his portfolio. He had gotten like 12% for the last couple of years. Good for him, right? And as we got into the conversation, we started digging into his full financial picture, like I do with everybody over Zoom. It's about an hour and a half call. We get into all the details, and including his debts. So he had a couple mortgages, he had a boat payment, a couple of car payments, some medical loans that he hadn't paid off, some student loans that he hadn't paid off. This guy was paying about 80 grand a year just servicing the interest payments. And that was a good chunk of his, almost a third of his income was just going to service the interest. So it didn't matter that he was earning 12% pre-tax in his 401k. What he was doing was he was running hard, beating his head against the headwind of 30+% of his income just falling out the door to a bank.
Wow.
So what if you could create something like that where you train and teach your children, the future generations and ourselves on what you could do to stop that madness, stop the insanity, and to live a little more sane with your money? What are your thoughts, Josh? What would you do? How would you answer that question?
Man, that's so good. I think if we had a class like that, at the high school level, maybe even started in middle school or something like that, it can't be taught by the professors. It can't be taught by the school system. It can't be taught by
Right.
bankers, right?
Yeah. Right. Yeah.
Has to be taught by entrepreneurs and by investors. It has to be taught, maybe the full community gets to teach it, but everybody gets a voice. Oh, the banker just talked this. Hey, how about this, right?
Right.
Man, what a great, it would have to be like a extracurricular panel discussion, I think would be
Yeah.
incredible. I would love to be a part of that. Middle school, high school, talk to these kids about money,
Right.
give them $100 and say, here's $100 at the beginning of the year. Come back with more at the end.
I love it, man. Let's make calculus extracurricular, and let's make this course a core competencies course, right? Calculus, maybe not, or maybe advanced science or something. Let's move that for the folks that really want it. Because I have not used the periodic table since I graduated high school, but I am using banks every single day, right?
Holy moly. Yeah. I mean, I am pretty good at mixing drinks, so maybe that periodic
There you
table
go. Yeah,
worked in there
love
pretty
it.
good.
Right
And
on.
my coffee's, pretty
Hmm.
good. So let's ask this, Mark, for fellow deal makers in the audience who want to explore this a little bit more. Where's a good place where they could come, connect with you, learn from you, and maybe do a deal with you?
Yeah, the best place we can go and just get to know each other more. If you're looking for some more sanity in your financial life and you want real wealth without a bunch of market risk and you want to be able to control the banking function in your life, check out our podcast at notyouraverageFinancialPodcast.com. That's notyouraverageFinancialPodcast.com. And if you're ready to take that first step, guys, just jump on that button at notyouraverageFinancialPodcast.com. Click the button that says request a meeting, and we can have a 15-minute quick chat. I'd be happy to answer the call and say hello to you and just get to know you a bit and see if this strategy or other strategies would help you toward your goals. So that's notyouraverageFinancialPodcast.com.
Very cool. Mark, what question should I have asked you, or do you wish someone would ask you, like that we didn't go over today?
I think really the one piece that I didn't touch on that I'll just mention quickly is, again, there is a long range view here, and don't look at this as a get rich overnight tool. But don't let birthday candles count you out if you think you're too old, or if you've got some health issues. I've found people who are in their 70s, 80s even, that are either getting the policy on themselves or getting it on their spouse or kids. You can insure somebody but not be the insured. In other words, you can own the policy. I had a guy one time, he'd had a quadruple bypass, totally uninsurable. Great guy, wanted to bank on himself. So he got a policy on his wife and his adult children and his grandchildren. He's got 12 policies now, and he gathers his whole family around once a year to show them their dividend statements. I just think that's really cool, because he's not just preparing money for the people, Josh, he's preparing the people for the money. And what he does is, in that meeting around that table, he says, here's the car policy, here's the business policy, here's the real estate policy. And he says, kids, I better never hear of you going to a bank down the street. You come to the bank of mom and dad, and you borrow from us. Don't use those shysters down the street. Use the bank of mom and dad. And when the kids borrow from his policies and pay him back, who does that ultimately benefit?
Them.
That's right. It's life insurance, right? So one day when he does pass, many years from now, he's leaving the ownership of those policies now to his children and his grandchildren. And guess what? That's 4 generations of wealth. If you think about that, walk that all the way out, because those grandkids will ultimately pass away someday, many years from now, giving it to his great grandchildren who are not even born yet. Now, that is long range thinking. So that's one thing just to leave your listeners to think long range. Airplanes don't fly you to the grocery store, they fly you across the world.
Very cool. Very cool. So, Mark, this has been awesome. We've got not your average financial podcast.com. So that's a good place where people could just start the conversation. They could learn a little bit and then also engage with you on this. Did we miss anything else in this podcast interview? At least this first one. I'm sure we'll do other
Oh,
kind of
yeah. Yeah.
conversations in the
Well,
future.
like we said earlier, never drink the arrival syndrome Kool-Aid. There's always more to learn, Josh. So, yeah, I'm sure we missed something. Let's keep learning.
Sounds good. Fellow deal makers in the audience, as always, reach out to our guests. Say thank you for being on the show. Thank you for sharing, for taking the time to share their knowledge and wisdom. Reach out to them. Say thank you for being on the show. And if what they're saying aligns with what you want, reach out to them and find a way to do a deal together. If you're working on a deal, looking for a deal, or want to talk about it here on the podcast show, head on over to thedealscout.com, fill out a quick form, maybe get you on the show next. Till then, talk to you all on the next episode. See you, everybody.